Hey everyone, and welcome to this guide. If you've been hearing about crypto, blockchain, or Web3 and feel a bit lost, you're in the right place. This is your official starting point to understanding it all. Our goal here is simple: to demystify the jargon and give you a solid foundation. We'll break down what crypto is, how it actually works, and why there's so much excitement around it right now. We're going to keep things clear, simple, and totally jargon-free. At its core, crypto is digital money. Think of it as a way to send, store, and spend value online without needing a bank, PayPal, or Visa in the middle. It's peer-to-peer digital cash. This magic happens thanks to something called blockchain technology. Blockchain is a decentralized network, meaning it's spread across thousands of computers, and no single person or company controls it. Anyone can use it, and it's open for everyone to see. The benefits are huge. It's global, often much faster than traditional systems, and you have full ownership of your funds. It offers freedom, transparency, and control over your own digital assets. So, why all the buzz? A big part of it is the investment potential. Assets like Bitcoin and Ethereum have seen incredible growth. But it's much more than just price charts. People are excited about the technology itself. It allows us to build entirely new financial systems and online communities that don't rely on big banks or corporations. It offers a way to store value independently, which is especially appealing in uncertain economic times. Beyond just being digital money, crypto is programmable. This means it can power all sorts of applications, games, digital contracts, and even new forms of digital communities. It's not just an investment trend. For many, it's a movement towards a more open and user-controlled digital world. The crypto story really begins with Bitcoin. It was launched in 2009 by an anonymous person or group known as Satoshi Nakamoto. This happened right after the 2008 financial crisis, offering a direct alternative to the traditional financial system that many felt had failed. The core idea was revolutionary: create money that isn't controlled by any government or bank. Instead, it would be controlled by math and computer code, transparent for everyone to see. Bitcoin introduced key features like a limited supply of 21 million coins, designed to prevent inflation, and no central authority to manipulate it. This concept of pure, digital scarcity and decentralized control quickly gained traction. It proved that digital money could exist and thrive outside of traditional institutions, paving the way for everything that came after. Okay, let's break down blockchain, the engine behind crypto. Imagine a public, digital ledger or a notebook that records every single transaction ever made. That's essentially what a blockchain is. When a transaction happens, it's recorded, like writing an entry into a page of this notebook. Once a page is full of transactions, it's added to the chain of previous pages, creating a permanent, chronological record. This ledger is shared across thousands of computers around the world. This distributed nature makes it incredibly secure. It's nearly impossible for anyone to fake, alter, or delete a transaction because thousands of copies would need to be changed simultaneously, which is practically impossible. It's a trustless system, meaning you don't have to trust a bank or company. The code and the network ensure the integrity of the data. One of the most powerful aspects of crypto is that it gives you true ownership of your money. In the traditional system, when you put money in a bank, the bank technically holds it, and your identity is tied to an account controlled by that company. With crypto, you control your own funds directly. No bank can freeze your account, and no platform can shut you down or take your assets away. Your money is secured by private keys, which are stored in your crypto wallet. Think of it like owning digital cash that no one can confiscate, as long as you keep your private keys safe. This is why you often hear the phrase "not your keys, not your coins." It highlights the responsibility and power that comes with holding crypto. So, if you control your own funds, where do you keep them? That's where a crypto wallet comes in. It's not a physical wallet holding money. Instead, it's a tool that stores your private keys. These keys are what prove you own your digital assets and allow you to send them. There are different types of wallets. Hot wallets are connected to the internet, like mobile apps or browser extensions, and are convenient for everyday use. Cold wallets are physical devices that store your keys offline, offering maximum security for larger amounts. The crucial thing to understand is the responsibility. If you lose your private keys or the recovery phrase associated with your wallet, you lose access to your funds forever. There's no customer support line to call to get them back. While Bitcoin started the revolution, Ethereum is arguably just as important. Launched a few years after Bitcoin, Ethereum introduced a groundbreaking concept: smart contracts. These are pieces of code that live on the blockchain and automatically execute when certain conditions are met. Smart contracts opened up a world of possibilities beyond just digital money. They enabled the creation of decentralized finance, or DeFi, where you can lend, borrow, and trade without banks. They power NFT marketplaces, blockchain games, and even decentralized voting systems. Ethereum is essentially a global, programmable platform for building the future of the Internet, often referred to as Web3. It allows developers to create complex applications that run on a decentralized network, free from single-point control. Understanding why crypto has value can be tricky because it's not backed by a government or a physical asset. Its value comes from a combination of belief, scarcity, utility, and demand. Bitcoin, for example, is valuable because of its limited supply, its decentralized nature, and the trust people place in its network. Ethereum is valuable because its network is used constantly to build and interact with decentralized applications. Stablecoins, like USDC, hold value because they are pegged to real-world currencies like the US dollar. Ultimately, crypto's value is driven by its utility, its inherent scarcity, for many coins, the trust in its underlying technology, and the network effect of more and more people adopting and using it globally. The underlying blockchain technology is incredibly secure. Transactions are transparent, permanent, and cryptographically encrypted, making them extremely difficult to tamper with. However, this doesn't mean crypto is risk-free. The biggest risks in crypto often come from user mistakes, not the blockchain itself. Clicking on scam links, accidentally sharing your wallet information, or buying fake tokens are common ways people lose funds. The technology is secure, but human error can create vulnerabilities. To stay safe, always double-check wallet addresses before sending funds. Never, ever share your seed phrase or private keys with anyone. Take your time with transactions and be wary of anything that seems suspicious or too good to be true. You might hear the term Web3 a lot in the crypto space. Think of it as the next evolution of the Internet, powered by blockchain technology and designed to be owned by its users. This is a big shift from the current Internet, often called Web 2. In Web 2, large corporations like Google, Meta, and Amazon control vast amounts of data and your online identity. In Web 3, your data and identity are tied to your crypto wallet, which you control. You own your digital assets and your online presence. Web3 features include logging in with your wallet instead of passwords, earning tokens for participating in online communities, and even having a say in how platforms evolve through voting mechanisms. The goal is to create a fair internet where users have ownership and power, not just companies. Buying crypto is much easier than it used to be. The most common way for beginners is through a centralized crypto exchange. Platforms like Coinbase, Binance, or Kraken are good places to start. You'll typically need to sign up and complete an identity verification process, similar to opening a bank account. Then, you add a payment method, like a bank card or a bank transfer. Once your account is set up, you can buy popular coins like Bitcoin, Ethereum, or a stablecoin. For beginners, it's wise to start with small amounts to get comfortable with the process. Once you've bought crypto, you can either leave it on the exchange or transfer it to your own private wallet for greater security and control. Stablecoins are a special type of cryptocurrency designed to maintain a stable value, usually pegged to a real-world asset like the US dollar. This means one stablecoin is typically worth $1. Their purpose is to provide a safe haven within the volatile crypto market. You can use stablecoins to store value, trade between different cryptocurrencies easily, or earn yield through lending or staking, all without needing to convert back to traditional currency. Examples include USDC, which is backed by actual US dollar reserves, USDT, Tether, and DAI, which is backed by other cryptocurrencies in a decentralized way. Stablecoins act like the cash layer of the crypto ecosystem, making transactions and trading much smoother than constantly dealing with price swings. DeFi stands for decentralized finance. It's an exciting ecosystem of financial applications built on blockchain technology, primarily on Ethereum. The key idea is to offer traditional financial services without relying on banks, brokers, or other intermediaries. With DeFi, you can do things like lend your crypto to earn interest, borrow funds against your crypto assets, swap between different tokens instantly, or stake your coins to earn rewards. These services run on smart contracts, making them available 24/7 to anyone with an internet connection. While DeFi offers incredible opportunities, it also comes with risks. Smart contract bugs, scam tokens, and unstable platforms are possibilities. It's crucial to do thorough research before interacting with any DeFi protocol. NFTs, or non-fungible tokens, are unique digital assets that prove ownership of a specific item. Unlike regular cryptocurrencies where each coin is identical and interchangeable, like dollar bills, each NFT is distinct. They are often used to represent ownership of digital art, music, videos, or items within video games. NFTs are significant because they bring the concept of ownership to the internet in a verifiable way. They live on a blockchain, which provides a built-in, transparent history of who has owned the item. They cannot be copied or faked easily. Artists use NFTs to sell digital creations directly to collectors. Gamers can truly own and trade in-game items. Communities use them for access or identity. While still evolving, NFTs are unlocking new possibilities for digital ownership and creativity online. Staking is a way to earn passive income by helping to secure a blockchain network. It's used by blockchains that operate on a system called proof of stake, which is an alternative to the energy-intensive mining used by Bitcoin. In staking, users lock up a certain amount of their cryptocurrency to participate in validating transactions and creating new blocks on the blockchain. In return for their contribution to network security, they earn rewards, typically in the form of the same cryptocurrency they are staking. Think of it like earning interest on your savings, but with a crypto twist where you're also contributing to the network's operation. Popular blockchains that use staking include Ethereum, after its upgrade, Cardano, and Solana. Keep in mind that your tokens are usually locked for a period, and returns can vary. Sending and receiving crypto is a fundamental skill, and while simple, it requires careful attention. To send crypto, you need the recipient's wallet address and you need to make sure you are sending it on the correct blockchain network. You open your wallet, select the cryptocurrency you want to send, enter the recipient's unique wallet address, choose the amount, and confirm the transaction. You'll also pay a small network fee, which goes to the validators or miners who process the transaction. The most crucial warning here is to always double-check the recipient's address. Crypto transactions are irreversible. If you send coins to the wrong address or the wrong network, those funds are likely lost forever. Entering the crypto world can feel overwhelming, and it's easy to make mistakes. Some common ones include sending coins to the wrong blockchain network, which is a frequent and costly error. Falling for phishing links or downloading scam apps is another major risk. Sharing your seed phrase or private keys with anyone is the fastest way to lose everything. Using weak passwords on exchanges or not enabling two-factor authentication leaves your accounts vulnerable. And a very common mistake is investing money you cannot afford to lose, especially due to the market's volatility. Crypto demands personal responsibility. There's no central authority to bail you out if you make a mistake. Take your time, double-check everything, and avoid making decisions based on fear of missing out, or FOMO. Scams are unfortunately prevalent in the crypto space, but most can be avoided with education and caution. A general rule of thumb is, if it sounds too good to be true, it almost certainly is. Be extremely wary of fake airdrops or giveaways that ask you to connect your wallet or provide sensitive information. Promises of guaranteed returns or incredibly high, fixed interest rates are red flags. Watch out for impersonators on social media or phishing emails trying to trick you into revealing your details. Stick to trusted platforms and exchanges. Never, ever share your seed phrase or private keys with anyone, for any reason. Question any unsolicited requests for information or funds, and remember that legitimate projects won't ask for your private keys. Once you start acquiring different cryptocurrencies, you'll want to track their value. There are many tools available for this, such as apps and websites like CoinGecko, CoinMarketCap, Zapper, or CoinStats. Many exchanges also have built-in portfolio tracking features. It's also important to keep good records of your purchases, including the date, price, and amount. This is crucial for tax purposes in many countries. Given the market's volatility, it can be tempting to check your balance constantly. Try to avoid this, it can lead to emotional decisions. Instead, zoom out, think long-term, and don't let daily price swings dictate your strategy. The term altcoin is simply used to describe any cryptocurrency other than Bitcoin. Since Bitcoin was the first, everything else is considered an alternative coin. There are thousands of altcoins, each with different purposes and technologies. Some altcoins are platforms like Ethereum or Solana, designed for building applications. Others focus on privacy, specific industries, gaming, or even just internet memes. Altcoins can offer the potential for very large gains, but they also come with significantly higher risks compared to Bitcoin or Ethereum. Many altcoins are heavily influenced by hype, news, and social media trends. Before investing in any altcoin, it's essential to do thorough research on the project, its team, its actual use case, and its tokenomics. Don't just buy because someone on the internet said it's going to the moon. Tokenomics is a term that combines token and economics. It refers to how a cryptocurrency token works within its ecosystem. Understanding tokenomics is crucial for evaluating the potential value and sustainability of a project. Key aspects of tokenomics include the total supply of tokens, the maximum number that will ever exist, and the circulating supply, how many are currently in the market. You also look at the token's utility, what can you actually do with it? Is it used for payments, governance, staking, or something else? Factors like how tokens are distributed, whether the supply is inflationary, increasing, or deflationary, decreasing, and how tokens are earned or burned all impact its value. Strong tokenomics can support sustainable growth, while weak tokenomics, like a supply heavily concentrated in a few hands, can lead to instability or crashes. One of the defining features of most cryptocurrencies is decentralization. This means no single person, company, or government controls it. Control is spread across various participants in the network. This includes the developers who write and maintain the code, the validators or miners who secure the network by processing transactions, and the communities of users who hold and use the assets. For many projects, token holders can even vote on proposed upgrades or changes to the network. This decentralized control makes crypto networks incredibly resilient and hard to censor or shut down. As a user, your voice and participation matter, especially if you hold governance tokens that allow you to vote on the project's future. You're not just a customer, you're a participant in the network. DAO stands for Decentralized Autonomous Organization. Think of a DAO as a new way to structure a company, club, or community that isn't run by a traditional hierarchy or CEO. Instead, it's governed by rules encoded in smart contracts on a blockchain, and decisions are made by token holders through voting. DAOs can manage community treasuries, fund new projects, vote on proposals, and coordinate activities without needing traditional management structures. Examples include DAOs that govern major DeFi protocols like Uniswap or Aave, or even communities focused on collecting NFTs or funding public goods. DAOs are a powerful example of how crypto enables new forms of collaboration, ownership, and decision-making that are more transparent and community-driven than traditional models. They show the potential for truly decentralized governance. Beyond the technology and investment potential, there are deeper reasons why people believe in crypto. At its heart are values like freedom and control, the ability to control your own money and digital identity without relying on intermediaries. It offers access to financial tools for anyone with an internet connection, potentially empowering the billions of unbanked or underbanked people globally. It represents innovation, a new kind of internet that empowers creators and users rather than central platforms. There's also the value of transparency, with open, verifiable systems, and for many, a sense of hope for a fairer future not controlled by a few large corporations. Crypto provides tools for individuals to take control, whether that's by investing, learning, or building. Since you are your own bank in the crypto world, keeping your assets safe is entirely your responsibility. This means taking security seriously. Always use strong, unique passwords for any exchanges or online wallets. Enable two-factor authentication, 2FA, on every platform that offers it. This adds an extra layer of security. If you're using a software wallet, write down your seed phrase and store it offline in a secure location where only you can access it. Never store it digitally or share it. Never share your private key with anyone. Be cautious about accessing sensitive crypto accounts on public Wi-Fi networks. For larger amounts of crypto, consider using a cold wallet, a physical device that keeps your private keys offline and away from internet threats. Protect your vault. The regulatory landscape for crypto is still evolving rapidly around the world. Some countries have embraced it, while others have imposed restrictions or even outright bans. It's a legal gray zone in many places. As a user, it's important to be aware of the regulations in your own country. Understand the tax implications of buying, selling, or trading crypto. If possible, use exchanges that are registered and compliant with local regulations. Be cautious with transactions that offer complete anonymity, as these can attract scrutiny. It's important to note that in places like the UK, most crypto assets are not regulated. This means there's no consumer protection if something goes wrong, and you could lose your entire investment. This is not financial advice, but a reminder to understand the risks and regulatory environment wherever you are. The world of crypto moves fast, and you don't need to learn everything overnight. The key is to keep learning consistently. There are many great resources available. Trusted YouTube channels, like CryptoPulse, can provide clear explanations and updates. Websites and tools like CoinGecko, Masari, and DappRadar offer data and insights into different projects. Follow credible voices on social media platforms like X, formerly Twitter, but always verify information. The best way to learn is often by doing, so start with small amounts to get hands-on experience. Join crypto communities on platforms like Reddit or Discord to ask questions and learn from others. It's like learning a new language, confusing at first, but incredibly rewarding when it starts to click. One of the biggest pitfalls for beginners is the fear of missing out, or FOMO. You hear stories of people getting rich overnight, and it's tempting to jump into whatever is currently hyped. But patience, not panic, is key to success in crypto. Avoid chasing pumps or investing essential funds based on speculation. Don't blindly copy what others are doing without understanding why. Take your time to learn the fundamentals, research projects properly, and make decisions based on your own understanding and confidence, not just emotion. The crypto market is volatile, and prices can go down as well as up. Those who take a thoughtful, long-term approach and truly understand the technology and its potential are the ones most likely to succeed. Crypto rewards the patient and the informed. If you've made it this far, congratulations. You've taken the first big step in understanding the basics of this revolutionary technology. You now have a grasp of blockchain, wallets, smart contracts, DeFi, NFTs, and much more. You also know how to start buying safely, how to avoid common scams, and where to go to keep learning. It might still feel like a lot, but remember that crypto is about empowerment. It gives you tools to participate in a new digital economy and a new kind of internet. This isn't just a financial trend, it's a technological shift and a potential revolution in how we interact online and manage value. Stay curious, stay cautious, and keep learning. Welcome to the CryptoPulse community, and welcome to Web3.